Good afternoon, ladies and gentlemen, and welcome to the IQGeo Group PLC interim results presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available on your Investor Meet Company dashboard. Before we begin, we'd like to submit the following poll. I would now like to hand you over to Richard Petty, CEO, and Hayward Chapman, CFO of IQGeo Group PLC. Good afternoon.
Good afternoon, and thank you very much.
Good afternoon.
So very warm welcome to everyone that's joining us here this afternoon. My name is Richard Petty. I'm the CEO of IQGeo. I joined the company late in 2016, and with me here today is our new CFO, Hayward Chapman, who joined us last Thursday. So a blend of new and old, if you will. Today I'm presenting a deck of slides that we've been presenting to all of our investors. And so something that's been important, certainly for our longer term investors, is understanding a little bit about Hayward. So Hayward is somebody we've recruited to the company after quite an exhaustive search. We were looking for three things from our CFO. First of all is his experience as a CFO of an AIM listed business, which Hayward has. Second thing we were looking for was experience running a high growth SaaS business, which is what we had. And the third thing that mattered to us was cultural fit. We're a global business with operations in the US, Canada, continental Europe, UK, of course, Japan. And so we wanted to make sure that our CFO was somebody that could work with all of our teams around the world. So I'm going to ask Hayward just to say a few things about himself and a little bit about what attracted him to IQGeo.
Good afternoon, everyone. It's Hayward Chapman here. As Richard said, it's my third day in the seat. So just a little bit of my background. I'm a chartered accountant by training. I've worked pretty much since I left practice in tech companies, both listed and private equity backed, specifically sort of very high growth companies. So when I was at Northgate, it grew from about 140 million turnover when I joined to 810 million turnover by the time I left. My latest company that was listed on the AIM was called Castleton Technology PLC, where I was the CFO. And I was part of the team that grew that from an AIM listed cash shell in 2014 to a 26 million turnover, 6.4 million EBITDA software company with recurring revenues of just under 70% and over 100% cash generation. And that was, as I said, that was done through 10 acquisitions with organic growth over a 5-year period. So I'm used to sort of fast-growing companies. Obviously, Castleton has given me my AIM-listed experience that Richard required. A lot of the investors at Castleton are the investors of IQGeo as well, so I know some of them. And I'm here to try and add a little bit of experience in terms of growing a recurring business, and also I've got acquisition experience, which I hope we can achieve some of that here as well through some bolt-on acquisitions. So I think that's enough on me, and I'll hand back to Richard to
keep going.
Continue the presentation.
Thank you, Hayward. So I've got a couple of slides here that will act as an introduction to IQGeo, who we are, what we do, what problems we solve. So at IQGeo, we call ourselves a geospatial productivity and collaboration solution for telcos and utilities. So let me unpack that a little bit for you. What we aim to do is to improve the performance of any network operator in the following key areas. So we aim to improve sales, we aim to facilitate planning and design, we aim to accelerate construction, and we help improve maintenance of the network. So our product you can see on the screens on the right hand side, and the most important aspect of this, or the most obvious aspect of this product, is that it is a geospatial product. In other words, it presents an awful lot of information in a geospatial format. In other words, in a map. like situation. But our product is much more than just a map. It's more than just a series of lines on a map. What we produce here is a digital twin of a network that is accurate in all of its technical detail, that is geospatially accurate, and that contains the recipe, if you will, for that network operator. In other words, when you extend the network, when you design new elements of it, when you design a new neighborhood, it designs it the way they want it constructed. Different network operators will have different ways of doing things. And so we contain not only a digital representation of the network, but a digital representation of all of its technical aspects. So you can think of us as, imagine that you could zoom down on Google Maps and zoom right the way down to all of the infrastructure that you might see on a road, on a highway. Every manhole, every lamppost, every sewage pipe, every electricity conduit, every cabinet on the street. Imagine you could zoom below the road and see what's under the road. The soil composition, how many strata of road exist there, whether there's cobblestones underneath it. Imagine you could see the detail inside people's houses, the wiring in their homes, the set-top boxes, and so on. That is what we try and do for a network operator. It is accurate right down to individual components. And we are presenting information in real time about what's going on in that network. So we collect a lot of information from devices on the network, from sensing equipment, from IoT devices, and all of that combines to produce a real-time digital picture of that network for that network operator. And all of that is then packaged up with workflow and analytical tools for each one of these departments so they can accelerate the KPIs in their business that matter to them. As a business, we pivoted to subscriptions in 2019, and now everything we sell is on a subscription basis only. So this year, over 90% of orders was taken as subscriptions. And we deploy primarily in the cloud, and that could be on-premise cloud, or that could be third-party cloud like AWS or Azure. Subscriptions and cloud go hand in hand. And the reason this is important is because our customers are very cautious technology users. As you can imagine, network operators that have nuclear power plants on their website, or that are providing essential services for hospitals or military or cities or even residents, they're very cautious about the technology they choose. And so for them, it's important to be able to test and validate a product extensively before they roll it out. And so cloud and subscription capabilities really matter in that sense, because it means they can buy a few hundred users, test it extensively, and then at their own pace scale up to tens of thousands of users, which is the typical deployment size we will see at a tier 1 account. Most of our sales are done directly. These are complicated sales that we are trying to achieve and trying to close. We need a lot of expertise in our distribution organization. So most sales we do directly, but we have an increasingly significant partner network. Most of the selling we do in Japan, for instance, which is a very important market for us, is through NEC and other partners we have out there. So in certain markets, we do have evolved distribution capabilities. Europe is getting increasingly stronger with partners such as CGI. That is a channel we will be looking to expand increasingly in the future. We are a small company, but we are global. So our main markets are North America, where the majority of our business comes from, but we also sell in Europe and in Japan. Today, we have 50 tier 1 and tier 2 customers primarily as our customers. These are all paying customers. But you can see here that we have over 50,000 active users on our product. And if you divide those two numbers, you can see that our average user count per site is actually quite high. So over 1,000 on average. Now, in practice, what we see is more of a sort of polarization of that. And we see some accounts that are at sort of 4,000 users all the way up to 10,000 users. And on the smaller end, we'll see accounts of just a couple of 100,000. But the point is our product will scale to either extreme. and more importantly, at each individual account, we look for very high user accounts, and we will aim to sign up about 50% of employees to our product, which, combined with a subscription model, means that we can achieve very high continuous growth rates inside in an individual account once we have penetrated it. So I'd like to take a look at some of our half-year results. So these are some KPIs that we put out there in 2019, and as many of you will know, we don't have forecasts out there just yet. The reason being we're just a bit too small, I think, as a company to put forecasts out there. But we have asked our investors and prospective investors to measure us on things like order growth, on things like subscription rate growth, and on things like new logo or new account growth. And I'm pleased to report that in the first half of this year, we've done very well on all these counts. So in terms of gross product orders, we've grown that 120% period on period. So we've now achieved, we signed 5.5 million in new business in the first half. And a good part of that was a repeat business with existing logos that we signed up the back end of last year, very much proving our model whereby once we're in an account, we can upsell larger sales in the second and third year after the initial installation. So we had very nice repeat orders from a tier 1 telco in Canada, and a very nice repeat order from Tokyo Electric and Power, which is the second largest electricity utility in the world, where they bought a very large order of licenses for emergency response. So we're very pleased to see that. As a result of that, and as a result of sales we achieved in the second half of 2019, we grew our product revenue quite substantially. It was up 50% year on year to 3.6 million. And in addition to that, our recurring revenue was up very substantially year on year. And so this really shows the effects, the beneficial effects of pivoting to a subscription business. So our combined historical maintenance revenue together with our subscription revenue grew a very satisfying 170% in period on period, showing the beneficial effects of the pivot to subscriptions. As a result of these positive business trends, our gross margins were up. They were up 51%, up to 51% from 34% in the prior period, and we think that's very much a trend that is set to continue. Haywood, would you like to comment a bit more on these results?
Yes, just to add a little bit more information. So the total recurring revenues of 1.6 million now account for 34% of total revenue. So 34% recurring revenue out of the total of 4.7, and that's up from 16.7% in the comparative period. So obviously a very positive trajectory. And as you can see from the graph in the bottom right hand, that's had a knock-on impact in the gross margin, which is up 17 percentage points from 34% to 51%, and that's as a result of the change in the mix, obviously with our recurring revenues being subscription having a much higher gross margin than services revenue, and other revenues. Service revenues overall have broadly across the piece stabilised or remain the same. As Richard said, the third-party services have declined slightly from 1.3 to 1.1, but as more orders have come through, own party or IQGeo service revenues have grown quite substantially from 1 million to 1.9 million period on period.
Okay, thanks. Haywood, can you talk to these final KPIs?
Yeah. So headcount has remained stable. It was 72 at the end of last period, or comparative period. It was 71 at the end of FY19, and it has remained at 71 at the end of H1 2020. There's a geographical representation of that split, also by function later on in this deck, which we can look at. In terms of new logos, that's another metric that the company has said that we would like to be measured by. There were 5 in the comparative period, 3 new name logos in the current period, although the COVID-19 impact is that there's been a slight slowdown, and a couple have actually closed after the end of the period, so but not too far away, so it's broadly like for like, period on period. Obviously, net cash is a key metric. There's 11.2 million of cash on the balance sheet, and the company is still in a cash burn situation. But the very pleasing news is that has decreased significantly. So in the first half of FY19, the total cash burn was 3.6 million, which was the operating loss plus the cash spent on capitalised R&D. And in the current period, the cash burn was 1.9 million, so that's a 47% decrease, and that's made up of the 1.2 million operating loss, 0.1 positive movement in working capital, and 0.8 million spend on R&D. But again, as with recurring revenues, the trajectory is very much in a positive direction, and as those recurring levels of revenue build, we should see that decrease even further.
Excellent. Thank you, Hayward. So I'd like to bring everyone to the next chapter, where we talk about the market and our solutions. So I'd like to talk a little bit about what differentiates us from our competition and who we're up against. I've had a question here from Nick J. Who are you taking market share from, and how big is the market? So let me start by talking about the market in terms of competition. So I think what's important to understand in this market is that the market we address, which is geospatial for utility and telco, in our opinion, has been very poorly served in the past. And the reason is that our customer base finds itself in a situation where it has been trying to address very specific problems around the design, build, and management of networks with what are really quite generic solutions. So if you look at the geospatial market as a whole, and what I mean by this is these are large-scale cartography solutions used by everyone from universities, education, defense, motorways and infrastructure, railways, space exploration. This market is very well, the broad geospatial market is very well served by some products out there which have very fantastic, very good generic geospatial capabilities. So the market leader out there is an American company called Esri, ESRI, and they build products that are absolutely superb for mapping the valleys of Mars, or for creating a 3D surface area map of the Lake District. Great products for that. But when it comes to representing a 3D representation, a digital twin of a network model, say a fiber network or a coax network or a copper network or an electricity network, this is where generic products really struggle because they're not built for network operators. They're not built for an easy representation of a network. They're not built to be able to rapidly design an extension to a network. And so over time, these solutions have built up add-ons to them, some of them created by the users themselves, some of them created by partner networks. And so what you discover at customers that have tried to create network management systems using generic components is very complex architectures with a lot of add-ons and additions to cope with the fact that these systems are largely generic. In addition to that, a lot of these systems were built in architecture from the 80s and 90s, which tends to be client-server architecture, not really built for cloud, not really built for mobile. And mobility really matters because the vast majority of users of these systems tend to be roaming and tend to be out in the field, looking at assets in the field. So we believe that this market deserves better. They deserve built-for-purpose products. And so our solution is built along what you see at the top of this diagram, which is the network lifecycle. So not only are you able to visualize what is happening in real time on a digital network, but you can also manage the various phases of the network lifecycle. So from sales, marketing, planning, design, construction, operations, and maintenance, through to customer service. All of these departments need very specific views on the network and on geospatial data. And so what we say to our customer base is that we are for 100% of the companies, so not just the 5% of the traditional cartography users that the likes of Esri cater for, but actually everyone that needs access to the geospatial data in the context of their own departments. So yes, the traditional geospatial guys can use our product, but more importantly, 95% of the user base that needs access to the data can also get access to the information about the network. And the reason we can do that is because we are mobile first. In other words, we allow the tens of thousands of field workers access to the information that they need about their network. And we are also cloud first, which means that each department can increase their users as they need to. They can connect systems as they need to. They can have us ingest data as they need to in a very smooth way, a very performant way, and a very cost-efficient way. So the cloud first and mobile first, together with the network centricity of our product, really allows us to punch above our weight and to win customers against these very, very large incumbent vendors selling generic products. In terms of market size, we sell primarily to what we classify as tier 1, 2, and 3 network operators. These are sort of semi-industry standards in terms of how we define the size of a network operator, but they are broadly accepted in the market. So a tier 1 network operator will have, on average, more than 1 million endpoints, more than 1 million customers. Tier 2 will generally have between 500,000 and 1 million. A tier 3 below 500,000 endpoints. So that's roughly the classification we use for our tier 1, tier 2, tier 3s. The target market we go after worldwide is about 5,000 companies worldwide. Most of these in the markets we serve. So we don't go after Asia, we don't go after China, we don't go after Eastern Europe yet. So the total addressable market could probably be a lot larger. The 5,000 exist in the markets we serve, which is Europe, North America, and Japan. But inside each of these accounts, we are going after quite a large community of users. So if you multiply 5,000 times the potential 1 to 5,000 users that we're targeting, then the size of the market actually becomes very, very substantial. So as a target market, as target markets go, there's a lot of runway ahead of us. In terms of who we sell to and how we sell, we tend to go after the heads of each department. So you can see here planning and design, there'd be a head we go after there, or a head of construction, or a head of operations. And we tend to go in with sort of content-rich ROIs to address the problems unique to these guys. Sales cycles will vary from 12 months to 3 months, depending on whether it's a tier 1 or 2 or 3, or depending on how ready they are from a budgeting perspective. But anywhere between 3 and 12 months is typical. And this, by the way, is completely in line with any other sort of B2B business that I've ever worked in. In terms of product stickiness, I've never seen a customer reject our software once it was in. So generally speaking, we find that our product, once it's in, has very high user satisfaction rates and is very, very hard to dislodge. And once a system like this is in and running in one of our customers, they tend to be very long-lived. 15, 20 years is quite typical in terms of the life cycle of these products. So from a subscription perspective, that adds up to very, very important long-term revenue projections for us. We are we're an aggressive operator in this market. We market more and harder than our competition does. That tends to sort of treat this market as a cash cow, if you will. And to answer a question I've just seen here, have we lost clients to the competition? No. So far, touch wood, we've been very good at retaining our customers once we've won them. So we aim to address, in terms of how we sell, we go to our customers and try and solve existential problems for them. And that's very important. We don't go in and to our customers and try and sell a piece of technology. What we do is we go in and try and sell a solution to a business problem they may have. So typical problems that customers will have is where should they invest and how much will it cost them, how to accelerate construction times, how to accelerate time to revenue, how to maintain loyalty by keeping customers happy with the service they're receiving, and how to increase wallet share. So we really create really compelling, we try to create very compelling ROI stories around each of these. We've been able to measure the impact our systems have on customers, and we will take these success stories to new customers and show them and help them quantify the impact our solution will have, which helps accelerate the decision timescales. I'll just address one question before I move on from this slide. Moving away from legacy systems can be quite easy once a decision has been made to go with us. We have a lot of tools that allow us to very rapidly take data out of systems where they exist today. We are very proficient at converting data quickly. And we don't view ourselves as a services business. We don't like to take more services than we absolutely have to before we can get our systems live. So the less services we can do, the better. To us, it's all about getting customers live quickly. So we try to minimize barriers for getting customers off the systems they may have, so that we can get our customers live and paying out revenue quickly. So the biggest challenge in terms of getting a customer off a system really is about helping them see the ROI quickly. And so in this next slide, we'll just dip into one particular ROI case study so that all of you can see the kind of effort we put into demonstrating the value of our system and accelerating our sales processes. So in this instance, we're showing off a module. We're showing you a module around planning and design. And this product's all around short cycle design. So this is about quoting small design projects for our customers. And these typically are inbound leads, B2B inbound leads for our telco operators. And often what will happen is a business will call in and say, we're moving office and we'd like a broadband connection. How much will it cost to connect us? So without a tool like this, generally what is happening at these customers is a sales rep will take a call. He will then take the information from the customer. He'll put a request into the design team, and the design team will get back to him or her with a quotation for how much it will cost to connect that customer and timescales. And what we've observed consistently, excuse me, is that can take 5 to 8 weeks to turn around a design like that. And during that time, that customer may have got quotes from somewhere else and may not be available anymore by the time the telco is ready with a quotation. We've been to tier 1 customers in North America where they have over between 50 and 70% loss of that customer waiting for a quote, and therefore it's being able to turn around these quotations fast enough is a crucial element of the business that's impacting their win rate. So with our solution, what we offer here is some AI that is able to very rapidly create a network design once the solution's been given 2 endpoints. And so our AI is able to create a design in seconds, which means that the sales rep can give a quotation to that customer instantaneously and can issue paperwork instantly on the call, asking the customer to accept the quotation. So the benefit of this product is that A, the designs are turned around faster, B, the win rates are dramatically increased because you're able to provide a quotation real time. C, there is a vastly increased consistency in design quotes, which means you don't get the variability in designs, and you're much less likely to produce loss-making designs. And the last thing that is the benefit for our customers, D, you can actually reallocate or let go up to what are often thousands of designers being retained for this short cycle business. So you've got wins in terms of cost, you've got wins in terms of business or win acceleration, you've got wins in terms of time to revenue. So this is a great example of the kind of ROIs that we can generate for our customers, which just on this one business issue alone can amount to hundreds of thousands of dollars a month. So what makes us special? What makes us competitive vis-a-vis other players in this market? Well, we are built for purpose. We are built for network operators and nothing else. If you want to map the valleys of Mars, we're not the product for you. If you want to map a network, we are definitely the product for you. We map the entire network lifecycle, which means that we provide solutions for each and every department in an organization. We are mobile first, which means that the tens of thousands of users that you'll have in a tier 1 environment can use our system in the field, and that gives us field to office coverage. And we are cloud first, which means that we are super scalable, and customers can add users, they can add data, they can add connections at will, and enjoy an excellent level of performance at the right cost because the system is self-scaling. So in terms of our go-to-market process, this year has really been an interesting one for us. We've invested heavily in our digital content. Certainly compared to our competitors, we have more use cases, more webinars, more customer testimonials, more white papers out there than any of our comparable competition. And that creates a real center of gravity for us, as our head of marketing calls it, in terms of attracting potential users or potential buyers to our product. In addition to a lot of content, we invest heavily in intelligence that allows us to target potential buyers by name and with the kind of solution that we think they are likely to buy. So we invest heavily in uncovering prospect names. There's products like LinkedIn out there where we can search people by title, by department, and we will put all of these people into very comprehensive nurturing programs that helps them understand what we do for their peers, the kind of solutions we can solve for them, and that nurtures them along a path of more and more content that is appropriate for them, that is interesting for them, that is informative for them, and that as they are going along this path, automatically scores them in terms of a propensity of taking a call. And once these prospects have reached a certain level of engagement with us, only then do we pass them to a salesman for a call. And that results in a very high engagement rate with these prospects once a salesman is beginning to speak to them. So COVID in this context has been interesting for us because our customers and prospects are no longer relying on traditional channels for searching for solutions. Thank you. And searching for solutions, but they're relying more on digital content. And this puts us in a good position because we have great content online, and it means that customers are engaging more with our content as they research, and they are attending more webinars and attending more events where we can put them in touch with peers, put them in touch with our technical people, and research solutions that are appropriate for them. So our digital marketing platform has really paid for itself this year, and our pipeline has really grown in quantity this year because of the investments we've made here. We market to existing customers as much as we market to new customers, and as a result, you can see here that in addition to signing new logos in the year, we also sell more to existing customers, and we very actively upsell new services, new software to existing customers as much as we do to new customers. And so it's important for us to have new products and new modules and new solutions to sell to our customers so that we can achieve year-on-year continuous growth with each one of our new logos. So these are some of our utilities customers. There are more utilities operators in the world than there are telco operators, and so as a result, we have more utilities customers than we do. We have more utilities logos than we do telco logos. The market drivers in this market, I think, are really interesting, and I think this is a very compelling reason to invest with a company like us. If you look at broadband consumption over the course of this year, January to April this year, there's been a 50% increase in internet traffic. There's been a 60% increase in global streaming on media devices, and so to me this points to an almost insatiable desire for digital connectivity to the home and to the business. And so operators are scrambling to monetize this demand, to increase bandwidth, to increase the 5G connectivity on their markets, to increase fiber to the home, fiber to the business. And so this large investment into hardware and into connectivity actually translates into opportunities for us, because as customers are increasing the number of customers they connect, increasing the number of construction projects they're making, this puts pressure on their in-house systems, and it creates opportunities for us to go in and solve these pressures and create opportunities for them to add users to our subscriber base. So there's a really fundamental long-term trend here of investment in telco networks, which we can capitalize on because the incumbent systems are not equipped to solve these volume problems as quickly as we are. On the utility side, we're selling into a very, very important trend, which is climate change. And what we see here is that the end users of our customers here demand more diversified types of energy production. So with the introduction of more and more solar, wind, hydroelectric and ocean-powered technology, this puts increasing demands on networks, requiring them to be much more intelligent in terms of how they sense energy, how they route energy. And so all of that creates opportunities for us to sell much more intelligent geospatial systems that are able to provide more information about their network to all of their users internally. And so we see equally significant drivers on this market as well. And again, a very long-term trend of growth that will feed into the purchasing of operational systems like us. So I'm going to hand over now to Hayward to talk in more detail about our financials.
Thank you, Richard. So as you can see from the table on this page, revenues for the first half of FY20 were £4.7 million, and that's up by 30% from the comparative period. The gross profit was up by 98%, so there is, and that's partly due to a change in the mix. It's increased from 1.2 million to 2.4 million, and that, as I mentioned earlier, that gross margin percentage has gone up by 17 percentage points from 34% to 51%. There's been careful cost control over the period. There's been a reduction in obviously in travel expenses, and there was also a reduction in salaries across the company for a quarter of the year, which was in the first half. And as a result of that, the operating expenses are 0.3 million lower at 4.1 million than in the comparative period. Obviously, at an adjusted EBITDA level, there's a significantly decreased operating loss of 1.2 million, which is down from 2.8 million, and that's so the trend is very much in the right direction, as I've already said, for the recurring revenues and for the cash burn. Just go on to the next page.
Yep.
So you can see here the recurring revenues. There's been 1 million of subscription revenues in the first half, some of which is due, about 0.4 of that is due to sales in the half, and the balance is from subscription sales in the second half of last financial year following the switch to a subscription model. And what you generally see with subscriptions is that you get a lag to the order intake. So there's been about £0.9 million worth of annualised recurring revenue order intake in the half, but only 0.4 of that has made its way into the P&L because of generally that would have happened towards the, well, say that the average is the midpoint in the half, and you get a slight implementation delay. So you're not going to get all of those revenues coming through. So the balance of that 0.9 million of order intake, we should see an increased subscription revenues in the second half of the year. Maintenance and support has remained consistent, which we would expect, at 0.6 in each the current period and the comparative period, and therefore overall our recurring revenues of 1.6 million compared with 0.6 in the comparative period. So that's 34% recurring revenue compared with about 16.7% recurring revenue in the first half of 2019. Given the switch and the uptake of subscription, there's been less software licenses. So that 0.1 represents perpetual license sales, which is down from 0.7, and that's a trend that we would expect to continue at that low level. There's always going to be an element of license sales depending on customer requirements, but generally it would be lower. Services revenue, with the uptick of orders, there's been a sort of quite a pleasing increase in services revenues, which have increased from 1 million in the comparative period to 1.9 million, and this is IQGeo owned services. And then non-recurring revenues are 2 million compared to 1.7, largely as a result of that uptick in services. Third-party services decreased slightly. There's a couple of customers who take a lot of services when we work on third-party products. That's decreased slightly from 1.3 to 1.1, and we would expect that to stabilise going forward or decrease slightly to an extent. But the overall message is that uptick in the recurring revenues, which is, as I said, has gone from 16.7 to 34%. I've just had there's a question that's come in. When do you forecast to become profitable? As we've said, there are no forecasts currently in the market. But if you think about profitability, and I guess the key thing is cash flow positive, then given the current trajectories, we would expect that to probably be back end of FY21, early part of FY22. But as we've said, there are no current forecasts out in the market. We just go on to the next slide regarding our cash flows. So as I said earlier, there's 11.9 million of cash on the balance sheet, so there's ample headroom cash flow. The key point here is the cash burn, which is significantly reduced from the comparative period. So we've gone from about 3.6 million cash burn for each 6-month period down to about 1.9, and that is only going to get less as more subscription revenues are sold. So a very pleasing result, and again a very pleasing trend to go forward with. Just tick over onto the balance sheet. Key points here. I've already mentioned the cash. There's a reasonable level of trade and other receivables which are consistent. The business has a very low level of trade debtors, very good payers from what I can see, which is very good for a software company. It means that the product is easily installable. There's no lagged or significantly lagged implementation, very few implementation problems, so that gives you a low level of debtors. There's 3.7 million of intangibles, which is down to the capitalised R&D, so I expect that to build as the product is developed. And apart from that, the balance sheet is pretty clean. There's I'd say normalised level of trade and other payables. There's the lease obligations under IFRS 16, which have increased, but that's because a new lease has been taken on in the US. And there's also a 0.7 million loan, which is the Payday Protection Plan loan. It's effectively the same as in the UK, the furlough scheme that's given as a loan as opposed to paying directly to employees. So that's really the summary of the balance sheet. I think there's another question come in.
Yeah, I can answer that one.
Yeah, so Richard will answer that question.
When you're done with the financials.
I think I'm done on the balance sheet.
You think you're done on the balance sheet? Okay. All right, excellent. Yeah, so interesting question on our discounting policy. Andy E has asked, do you have to concede, or rather, do you stipulate a lower subscription rate per user? It's quite common with our contracts that we bake in banding, price bands into our contracts. So when a user starts on lower use counts, then they're paying a certain amount per user. And as they go into higher user counts, then the price per user does go down, but it's not retroactive. So what that means is, let's say we've got a price break at 500 users. Well, the 501st user will be on a lower rate, but the first 500 stay on the rate that is stipulated in the contract. So it's not as if you click through the user count, the whole user base is discounted. What we've got stays at that price, and as they add incremental users, it might come on as a slightly lower rate. But more importantly, more typically, what we find ourselves doing is upselling new functionality to the user base. So actually, there are two vectors as we go into each account. One is horizontal, if you will, where we're taking existing functionality and spreading it across the organization. But actually, as we go from department to department, we seek to upsell department-specific functionality, which generally means as the user count goes up, we are actually increasing the take per user because we're adding more and more modules into what is happening. So there's not really a sort of a law of diminishing returns in what we're doing here.
If you want to go to the next slide, I'll just talk about it.
Yep.
Talk about that. So the last sort of slide we've got to present on is just on the headcount. So it shows the split between sort of the technical consultants, what we've got in our sales and the sales engine, and then the R&D and administrative side of the business. So as you can see, over the last sort of between the end of FY19 and the first half of FY20, fairly consistent overall at 71 heads. The number of consultants has obviously increased as we're looking to, as more orders have come through, and we're looking to get those orders implemented. Sales and marketing down a little bit, but it does take time to get the right sales team. But there's a healthy number of sales team got to grow the pipeline. R&D has remained consistent at 16, so that's a core part of the business, and then 11. And if we look at the geographical split of those, 18 in the UK, Americas is by far the largest area, so we've got more people there, 47 people in the Americas, with a small contingent in Europe and Asia as well.
Good. So actually, there's one question that's come in here, which I'll try and answer. Can you look at our sales pipeline? Can you share numbers aggregate? Well, the answer is very sadly not, because then that would be the same as a forecast. I think the general thing I can tell you is that our pipeline is growing as our digital marketing does more and more. Sales cycles are quite long, about anywhere between 3 and 12 months. That gives us a long time to qualify an opportunity and to decide whether it's something we can do or it's something we want to do. So there is a fair, as the organization matures, we've become better at forecasting what we do, and I think we're close to a position where we will be able to start issuing forecasts to the market. Not just yet, but it's something we're discussing at the board level, and something we very much want to do in the coming months. I think so. In sum, before we hand over to questions, what I would the reason I like this business is because we have a niche product that is designed to do its job very, very well. It is very well differentiated from its competitors. The technology is bang up to date. And we are in a market which is growing. We are selling into a market that has problems that need solving with our technology. It is a global market, and it is a market that is underpinned by some very, very strong fundamental trends around 5G, fiber connectivity to the home, and climate change. And these are investment cycles that will last a long, long time. And so we, as a company, we will be able to ride this investment cycle, I think, for many, many years to come, and build a very attractive business, which to me has a high percentage of recurring sales, has high margins, and has high growth rates, all combined in one. So that's, what my vision is, and that's what I'm looking to build here. And I think all of the evidence from our performance over the last 3 quarters, I think underpins the fact that the market is there. We have the product, and we have the organization that can execute it. So it's a business I'm very pleased with, and it's a business that I think now that we can look to scale and grow across all of its markets, and to produce, as I say, an attractive investment.
Richard Hayward, thank you very much for updating investors there. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. The company have done a fantastic job actually in asking most of the questions that we've had, and pretty much all of them through the live event. But do please keep submitting them as you go along. And I'd just like to remind you that a recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Lastly, before I do go back to Richard and Hayward, I'd like to remind you that your feedback is important to the company. Immediately after the presentation is ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views. Richard Hayward, thank you very much for a very comprehensive job of addressing pretty much all the questions during the meeting. We did have a couple of pre-submitted questions as well, but I think you covered those off. Can you tell us how you're expanding your sales channels and partners globally, and obviously the typical sales cycle you have covered off, but is there anything further you could say about your channels and partners?
Yeah, so channels are an important part of us, and part of what we do. And in Japan in particular, we have a very, very effective channel. They're primarily through NEC, where NEC bundles our product up with other disaster recovery services that they sell. And they have a very large team. They have about 25 employees dedicated to reselling our solution across Japan. So that's an example there of a really strong sales partnership with a customer that has identified a need in their market that's unique to them, and they've identified a software product that complements other services that they sell. So we're really happy with that relationship, and are looking to do more and more with NEC in Japan. We also have other partners that we're signing up in Japan, including TIS, which is another very substantial integrator, and we'll be looking to work more with them. So that's a model that's proven its worth really well in Japan. And it's something we're continuously expanding. In Europe, we have a lot of opportunities with CGI. CGI is a listed North American integrator that has some very interesting geospatial skills, and have quite a large geospatial customer base across Europe. So we're doing more and more with them. And in North America, we have a whole range of partners that are constantly bringing us things. So channel is important for us, and we're actually one of the reasons we're looking to move our entire business to the cloud exclusively is because that will make channel sales that much easier. So part of moving to the cloud is not only to benefit our customers, but also to make our channel strategy that much easier, and to look to grow the amount of revenue that we get through third party. So I would say watch this space.
Fantastic, thank you indeed. The other pre-submitted question, I think you pretty much covered off with your ROI example and what ROI your clients look for. So I think that's pretty much covered off actually.
Well, I can provide just a bit more color there. The ROI that we see with this product, I think are tremendously exciting. So I gave you one example on design, but actually a really good and simple example is on engineering, field engineering, where what we've seen is that having a product like ours out in the field reduces the number of trips back to the office that engineers have to do. And so by eliminating 3 or 4 trips back to the office, and these trips are really around logging data and looking up what the next job is. Just by providing these people with a field enabled solution, you eliminate trips back to the office. And what that does is that returns 20% of their day to them. So for one person, you may think 2 or 3 hours is not that much, but you multiply that by 10,000 operators, and you're actually returning an enormous amount of available days back to the workforce. And so we've seen customers completely eliminate the use of subcontractors because of the dramatic increases in productivity they get from each of their individual employees. So, you know, the kind of ROIs that we see on our customer bases are really quite dramatic, and it really cements us as a solution that they can rely on and that they can grow internally because it delivers such compelling ROIs.
Fantastic, thank you. I know we have had a couple more questions just submitted in
Yeah.
of time, but I don't know if you do have time to have a scan through just any.
Yeah, see what I've got.
That'd be great.
Yeah, so 30% revenue growth is great. When can you grow at 80 or 100%? Oh, well, you sound like one of my board members now. So the answer is revenue will accelerate as we sign up more subscriptions and get those customers live. So I think it's a combination of adding salesmen, and this is one of the issues around cash consumption. So one of the reasons we are cash consumptive is because we have to invest ahead of the curve. With 12-month sales cycles, it means that you have to bring salesmen on and you have to sustain them for 12 months, sometimes longer, as they're getting their first deal to come in. So there is a cost of carry with expanding salesmen. And of course, with each salesman, you've got to bring in pre-sales to support them. And as we increase the number of opportunities we're looking at, we've also got to develop more because customer needs may vary from one opportunity to the next. So, you know, there is always a lead with expanding sales. So, you know, we're cautious of that. We don't expand too quickly and wind up with a lot of unproductive salesmen and high salaries to go with it. But on the other hand, you know, we don't want to just worry about being cash generative very quickly, because that, on the other hand, constrains our ability to grow quickly. So there's a balance to be made there. But I think we've got the model right. We now have a good set of ROI statements. We have good demos. We have good stories for customers, and we're now bedding down a model where we can slot salesmen in and be pretty confident about how long it'll take them to be productive. So as we expand that, you know, we're going to see bookings go up and we're going to see revenue go up. In terms of aversion to Asia, China, and Europe, so far reflective of better quality, but it's all simply international capacity. So our product tends to have a better ROI where cost of labor is high. So, you know, in Europe, in the US, you know, we see engineering costs at roughly $50, 50 euros an hour. And obviously, as you go up the food chain in terms of skills, it can get even higher. So, you know, most of the ROIs we generate are related to either saving of labor costs or accelerating customer revenue. And so, therefore, our ROIs tend to work better in advanced economies: Japan, Europe, North America. Now, we think that may change once we have a 100% cloud platform that can go through channel. And once we have that, you know, we can conceive perhaps signing up distributors for Southeast Asia. There's a lot of emerging economies where, you know, telco is growing very fast: Philippines, Vietnam, South Korea, possibly even mainland China. So as our product becomes truly multi-tenant, we can see then a distributor strategy picking that up and us generating a distribution model that lends itself better to emerging economies. But for now, there's plenty of runway left in North America, Europe, and Japan. And you know, we're going to stick to our knitting because we know the ROIs are most compelling where labor cost is high, and you know, there's plenty of mileage left in that particular market.
Fantastic. Richard Hayward, thank you very much. I think you've pretty much addressed every question we've had in, so investors, I'm sure, will very much appreciate that. And of course, if there are any other questions, the company can review all of those submitted today by investors. We'll publish those answered on the Investor Meet Company platform. Richard, just very quickly, I know you have summed up, but if you would, just in a couple of words, like to wrap up, and then I'll redirect the investors for feedback.
Well, thank you very much. Well, I'd like to say thank you, everyone, for all of those who took the time out to attend this demonstration. We've certainly enjoyed this platform. It's new and it's exciting. So my thanks also to the hosts. And we think we're going places. We think this is a high momentum business. I think this is an attractive investment. I've invested in this company, and I think we're doing a lot of things right. So I hope to see lots of you as lots of attendees today as investors in the future. Thank you very much.
That's great. Look, thank you both to Richard and Hayward for updating investors today. Could I ask investors not to close the session, as you will be automatically redirected for the opportunity to provide your feedback. If you access the meeting from our website, the feedback page will appear in front of you. Access via the link in the email. You'll be asked to log in and submit your feedback. It does just take a couple of seconds, therefore, to pop up in front of you. So on behalf of IQGeo Group PLC and Investor Meet Company, we'd like to thank you for attending today. That concludes today's session. Thank you very much indeed.